So in our journey so far, we have covered budgeting, ways to save money, types of investments available for beginners, and the brokerages you can use when you're a beginner in order to begin to invest. We have even framed where we're starting from, which is from a middle-class family that's a household with 2 parents and a kid, and that doesn't have a lot of extra money when we're searching for financial independence. We realize that the war and the journey to get to financial independence and complete and finish the war is going to be in small amounts, like say $5 here, $10 there, or $25 a week. So in this episode, we're going to take a look and start a series called Financial Fridays. What we're going to do with Finance Fridays is we're going to assume that we're going to save $25 a week and we're going to apply it to different types of investment. This is going to be something that I'm doing as an example for all of you. Hello, hello, hello. I'm Andrew and this is the Dad Manual. And this is my attempt as a dad and only a dad to show you over the course of the next year what it's like to save $25 a week in 4 separate accounts and how they actually act. Full disclosure, I'm not a financial advisor and I'm not a fiduciary, and I'm certainly not your financial advisor. This is just my attempt to illustrate 4 different types of investment for your entertainment. Now that we got that out of the way, we're going to limit this weekly series to 4 different types of accounts: value stocks, dividend stocks, growth stocks, and S&P 500 investments. In addition, you may remember that we talked about different brokerages that were available to us. In this case, I'm going to use Fidelity because I find Fidelity to be very easy to use when showing somebody else how to do something. It allows me to use it in very small amounts of money, it allows me to buy fractional shares, and it allows me a good representation on video as to actually show you what's going on. In addition to this, whenever I make these investments, my intention for every one of these investments is to hold them during the duration of this entire series. So since this series is going to go on weekly for more than a year, I plan on holding every investment that I purchase for an entire year. This is to show you the differences between short-term capital gains and long-term capital gains as time goes on. And lastly, with the exception of the S&P 500 index funds, it should not be assumed that everything I purchase every single week will be exactly the same. Conditions are different, and sometimes when you're following investments, not only do you find new opportunities, but you also develop theses that change where you'd want to put additional money. Think of something running up so far that you can't justify putting new money into it, even though you still believe in long-term growth potential. This being said, I also want you to know that I have no intention of purchasing something different every single week, and I'm going to use this video from Warren Buffett to explain further.
The question is about diversification, and I've got a dual answer to that. If you are not a professional investor, if your goal is not to manage money in such a way as to get a significantly better return than the world, then I believe in extreme diversification. I mean, so I believe 98 or 99%, maybe more than 99% of people who invest should extensively diversify and not trade. So that leads them to an index fund type of decision with very low costs. Because all they're going to do is own a part of America. And they made a decision that owning a part of America is worthwhile. I don't quarrel with that at all. That is the way they should approach it, unless they want to bring an intensity to the game to make a decision and start evaluating businesses. But once you're in the business of evaluating businesses, and you decide that you're going to bring the effort and intensity and time involved to get that job done, then I think that diversification is a terrible mistake to any degree. And I got asked that question when I was at SunTrust the other day. And if you really know businesses, you probably shouldn't own more than 6 of them. I mean, if you can identify 6 wonderful businesses, that is all the diversification you need, and you're going to make a lot of money. And I will guarantee you that going into a 7th one is going to, rather than putting more money in your first one, it's got to be a terrible mistake. Very few people have gotten rich on their 7th best idea, but a lot of people have gotten rich on their best idea.
As you can see from Warren's approach, he suggests becoming a specialist in a few different types of stocks rather than just hitting it with a broad swath across the board. So we're going to follow that mentality here and only pick a couple of different stocks over the course of the next year for each one of these different accounts. Now, before we move on, I think it's really important to quickly define the different types of investment accounts that we're going to have. As you can see here, When we're looking at value stocks, a value stock is a stock that is the price appears to be low relative to the company's actual financial performance. AKA, when we look at the fundamentals, we think that based off of the revenue, their future growth, it should be worth more than what it currently is. A dividend stock is a company that issues a dividend. Dividends come from profit. They're typically from well-established companies that have a track record of distributing profit to its investors. And a growth stock is a share of a company that it's anticipated to grow at a very high rate. Something that it's not well established, or it might just be becoming well established in the industry, and it's something that we're going to find that is going to have multiple double digits worth of growth every single year, maybe even as high as 20, 30, 40, 50% growth every single year for the next few years, as it's a disruptor of innovation. And last but not least, the S&P 500, which stands for the Standard & Poor's 500 Index. It's a market capitalization weighted toward the 500 largest publicly traded companies in the entire index. This means that we're actually trading the 500 largest companies, we're looking for the 500 biggest fish in the pond, and we're trying to emulate returns based off of what them as a whole produce. So as far as making the trades, we're going to go in the exact opposite order, and we're going to start with the S&P 500. On a quick search of the S&P 500, you can find different tickers such as Vanguards S&P 500 ETF VOO, which have been around since 2010 and house hundreds of billions of dollars that actually represent the S&P 500 remarkably well. If we search the VOO price over the course of the last, this looks like the last 5 years here, you can see that the graph almost exactly coincides with the graph of the actual S&P 500. So we should expect to get the same style of returns when we're doing this. So I'm going to come straight on over here, and notice I clicked my S&P 500 index account. I'm going to take ticker VOO, all right, and that's Vanguard's S&P 500. I'm going to do dollars because each one of these is $353 is what they're trading at today. Now you'll hear some people in the future tell you to buy on red days and sell on green days. I don't like to focus on that in the beginning, mainly because time in the market always beats timing the market. So I just want to put $25 in there, and I want to make it a market order because I don't want to fight having to actually, if it doesn't make the price, it not working. Preview that order. Whoop, I have to buy. Preview that order. And then I'm placing this with my normal. If I don't have the cash settle, it's going to be a violation. That's what this indicates. Place my order. And then I've got my order and it's complete. I can come back over here to my actual account. And coming back here into my account, I can see that I now own $24.75 of S&P 500 Vanguard Fund. Now you might be asking yourself, why did it only execute $24.75 when I told it to execute $25? The reason is just the fact that it has to make an exchange across multiple computers, and you should never get tied up with whether or not every single cent is being used. By the time we're talking about large retirement accounts, 25 cents missing in a trade on a dollar amount is not going to matter. So now on to growth stocks. What kind of YouTuber would I be if I wasn't going to include, yep, you guessed it, Tesla? Yeah, I'm a Tesla fanboy like a lot of other YouTubers out there. About 85% of my entire portfolio exists somewhere within Tesla across the different platforms that I use. I'm a big believer, and it doesn't matter whether you're talking to me about the 20 million vehicles by 2030. It doesn't matter if you're talking about the energy storage, the solar roof, the autonomous driving. It doesn't matter if you're talking about other items like software revenue from being able to play video games in the car in the future. There is a huge growth opportunity for Tesla, and they themselves, and I haven't even talked about Battery Day, they themselves talk about a 50% year-over-year growth. And I think there's a very reasonable chance we could be looking at a 10-banger from where we're at right now. Now, what does that mean when I say a banger? I'm talking about anytime a stock can give you a 100% return on your investment, that's a banger. So yes, you might be calling me crazy that by 2030 that this stock could be worth $8,400 within the period of 10 years. And I'm going to sit back and tell you, you would have probably thought you were crazy if you looked at Amazon back 7 or 8 years ago and you thought Amazon was going to be where it's at right now. This doesn't mean I think that Tesla is the only thing you should purchase. And by all means, my cost entry for Tesla was right around $90. So I don't want you to think that I'm trying to pump and dump this. I'm looking to hold this to 2030, 2040. It's just a matter of if I'm looking for a place to show somebody how a stock's going to perform in the beginning, Tesla's a pretty volatile example, and it's also one that I'm highly confident is going to go ahead and improve. I think it's going to get more, so we're going to go ahead and we're going to purchase $25 a Tesla. You can see I'm in the growth stock mindset. I'm over here with the growth stock account. I'm going to go ahead and punch in TSLA. I want to purchase a buy on TSLA in dollars, $25. And then I want to make that a market order so it comes up as I want. It's going to go ahead and give me $24.99 worth. And I'm going to preview this order. And there we go. I'm going to place the order. And now the order is done. I can come back over here and I can check what my portfolio is. So looking at my portfolio here, we can see that I just purchased $24.35 worth of Tesla. It's already gone down by 2 cents. I really don't care. I'm just going to save that extra 65 cents to try to make a purchase next week. And in addition to that, it's probably going to go up in the next 5 years. I see no reason to think it won't. So the next account that we're going to invest in is our dividend account. I'm going to purchase Verizon Wireless because it holds a very strong dividend at 4.55%. It's got a great business model. They've been profitable even through the pandemic. And when we're talking about overall, Verizon Wireless can definitely benefit from the 5G revolution. It's not something that I think is going away, and I think the dividend is probably here to stay. So I'm going to go ahead and move now to Fidelity, and we're going to go ahead and make this purchase of ticker symbol VZ, VZ, not VC, VZ, Verizon Wireless, buy, dollars, $25. Market order, preview order, and then afterwards place order. And there we go. We're good to go. We now own some Verizon Wireless. And now you can see with Verizon Wireless, I was able to go ahead and purchase it for the entire $25. It has gone down 1 cent since we began. That's okay. We're not really worried about that. What we're focused on is getting that beautiful, beautiful 4.5% dividend and the growth we're going to see from 5G. And now on to our last stock account we're going to purchase during this week. We're going to move to our value stock account. Now personally, I'm going to decide to go ahead and pick Dropbox. And that's because I believe in Dropbox as a company. You might see it's down a little bit today, but it's still a company that I use to this day. I've been using them so long that, probably when they first came out, I think they came out sometime around 2008. And I know when I used to have an old Palm Trio 650, which for you youngins out there, you probably don't know this is what phones used to look like before they got to be solid screen and the Apple iPhone took over the entire look of the world. That's kind of what we used to have. That was before. And I used to have Dropbox back then. It's a service that is still consistently growing year over year. Our analyst estimates show that we should be growing by 10.6% next year. And right now, even the analysts on the street, they say that with the current price of $23.62, they expect it to come in at somewhere around the vicinity of $28.33. This means that it's worth more at $23.80 or $23.62 than what the market's trading it at. I personally think that the value is closer to about $30. So I'm looking to get about 25% on my money back with this over the course of the next year, and I'll continue to buy it as long as it's under $25, $26, so that way we can continue to go ahead and make money. Now personally, when I come over here and I do this, their ticker symbol is DBX, so we're going to go ahead and do Dropbox, buy, dollars, and I want to do a $25 amount with a market order. This means that this is the first stock we're going to purchase that we're actually going to own a whole share of. Woohoo! We can write home to our mamas and we can tell them that we actually own stock now, right? Place the order, and yep, we are complete. Now I'm going to move back on over to the portfolio. So now we see the portfolio, and yes, we can tell that we have 1 share of Dropbox, 1.056 shares, and you'll notice by clicking on the Dropbox, it actually tells me our current stats. It tells me that people are telling us to buy the stock and that we can actually go ahead and buy or sell the stock as we want to. So next week when we come in here, we won't have to go back to the individual. We can just hit buy and it'll auto-populate the fields, and we can put in the $25 and we can go from there. Closing this up though, we can see that yes, we own our value stock, our dividend stock, our growth stock, and our Vanguard S&P 500 index fund. So there you go, guys. We've actually done it. We opened our brokerage account and we put in $25 into one of the strategies. I can't say how proud I am of you of actually getting this far. Only 50% of all the people in America are actually invested in the stock market. That means you're better off than half the people out there. This is only the beginning though, guys. It's going to take a lot of discipline to put in $25 every single week and continue on our journey to financial independence. This is not the end. This is just the beginning. So what I want to know is, are you as excited about this process as I am? Tell me about it down in the comments below. If you can't tell by now, I'm so excited by financial education and investing that my teeth itch. I just want to talk about it all the time. That's why I'm in front of the camera here. Help me spread that love to others by sharing this video and giving me a thumbs up. And hit that subscribe button if you haven't already. We post videos here every Monday, Wednesday, and Friday. And until next time, I'm Andrew Sherman. This is the Dad Manual. And always remember, failure isn't bad. Failure to try and learn is. Have a good one.